All right, good evening, guys. Ken at Tortoise Capital. Let's do a quick mic check here. Cool. This is the nightly podcast for July 1st, 2020. Thanks for staying alert. Stay alert, stay alive with the new link. So this is a note from Glenn Osborne. And I really think he was the inspiration for the kata. He's a professional musician, a marvelous organist. Recorded some amazing CDs, and he plays the pipe organ, a bunch of other instruments, just fabulous. Glenn Osborne, if you're interested in that kind of magisterial religious music, oh, it's just wonderful to listen to. So in a discussion he and I had, he was working out the idea that he was recording his rules, writing them down, and then trying to trade his rules with no errors. And he also has some programming skills too. So he was trying to get his rules very precisely written, and then could he execute them error-free? And when he was satisfied with them, then he could program that. Well, as part of doing that work, one of the things that he was doing was going back over the day's trades at the end of the day and then trading them with a clean chart, bar by bar, following his rules, and then noticing the difference between how he traded his rules live in the market versus how he traded his rules outside of the market, in an effort to discover what was the difference of being in the market, what were the contributors to the differences. And he discovered a lot of things as a result of essentially going back over the game film. So he was not only just reviewing the decisions that he made, but he also was trading it clean and fresh to see what he doesn't see. So if you're going back and reviewing your decisions and you're seeing where your markups are and then you're evaluating them, that'll certainly give you one piece of insight. But when you go back and trade it outside of the market hours and then see how it feels bar by bar, you get a real sense of what is the effect of the environment of knowing that it's live versus trading it almost in the simulator in that sense. And so then comparing those markups and those rules against some things that I was doing and some of his accountability partners gave him a chance really to understand a lot more about the total trading environment, the total trading system, which includes, his performance and his perceptions in the moment. So that was, I guess, a contributor to what we've got now with the kata is that sense of separating out your performance from the rule sets themselves. It's also connected to some work we've done with when we were doing a trading simulator for the frog system for the day trading workshop about 5 or 6 years ago. We were only trading the frog rules against a set of canned trading case studies bar by bar, and the first 20 or 30 that we would do, we had a very precise mechanical rule set, and we had a robot trade those, and so that generated the optimal objective performance. And then people would try to apply the rules to see how they compared to the robot, and then that would generate some insights into the error function. What were they misunderstanding, or what was their ability to execute with precision. Then after they had 20 or 30 trades, we then gave them the option to trade the case studies against the robot or to trade it with the insights that they generated from the first 30 trades, to use some discretion, like, taking the exit earlier or not taking the entry at all or something like that. And then we found quite a large difference in trader performance over 30, 40, 50 trades. And that gave us the insight that there really is such a thing as trader quality number. Well, that is part of what we're trying to recreate and experience with the kata form. So this is Glenn's write-up. I asked him to do a write-up for other folks that are just starting that kata journey. And so, just some things that I want to highlight, and that was, so even though he's only trading one symbol right now because he really wants to get to precision, he's marking up more than one, and he's noticing that on any given day, some of those charts are going to be very smooth. Like, if the market were smooth, some of them are going to be very smooth, but some will be very choppy. Some are trending, some are just sideways and noisy. And so he gets now a chance to see that relationship between the market's movement and how other symbols are reacting to it. And it gives him a feel for why there could be a real difference in performance depending on the kind of target you get. And so he was doing this work before the kata and the supported spring crossing. So he found it very helpful in clarifying his own rule set. So it's my contention now that if you start with the kata, and you will be able to discover which direction you want to take your extension of the rules to your own particular system. And so it's in his thought, mine too, that if you start with the kata, you already have a complete rule set, so it should be easier then to figure out what fits you. And he likes the idea of marking up a whole series of charts to give you exposure to different market conditions and allow you to get more practice out of a given day. And then you can find out whether any differences in your trading between live trading and paper trading are rooted in your knowledge of the system, your execution of the rules with precision, or in your psychology that's affected by the live trade. And do you know your platform well enough to execute rules when the action is required? So that can be a big difference in a learning curve between the paper trading and back testing with programming, and then actually executing with your infrastructure going forward. And then ultimately, is there something in your psychology that is reacting to the rule set? So you select your rule set on the basis of your rational mind, but then you trade it with the combination of your rational mind and your emotional mind. The chimpanzee is in there too. So I just thought that was worth. I thought that was worth sharing. I want to, before we get too deep of a dive, I just want to point. I think Betty sent me this an article to scan. This one was talking about, whether or not there are conditions available for another big short, compared to 2007, 2008. That's a great movie to watch, by the way. The psychology of investing, and then the long-term big money players. There's a lot of lessons in that one. So the article was examining some different candidates, and then this chart really caught my eye. And this is simply doing the ratio between the commodity index and the S&P 500 equity ratio. So you can see right now that at the peak of certain crises, like oil crises, Gulf War, and financial crisis, the commodities were at a premium because there was a crisis that was really threatening the underlying transportation infrastructure, for example. And so you were getting commodity prices way off the chart. And much of that, with the first two anyway, much of that is dominated by the contribution of the price of oil to the overall commodity index. So that would partially explain why the numerator was so large. And because of fear, you get simultaneously a large numerator and a small denominator, the S&P at a low. So you get those really amazing spikes. Well, the financial crisis in 2008 is not so much energy prices as it is really just the the crashing of equities. Well, at the bottoms there, you notice the tech bubble collapsing in 2002 gives you an extremely large relative denominator, and the S&P was at like an all-time high. And although commodities weren't especially cheap, it was just that the tech bubble was so high that you get that inverse look. Well, that's the terrain that we're in right now. Only now it's a combination of both very large denominator because the S&P is near all-time highs, and the numerator is so small because of the slowdown in economics has been, crushing commodity prices, especially oil. Well, after each one of those peak experiences, those peak moments, there's been a very sharp reversal to the other side. So this has kind of launched me into looking at various exchange traded funds and notes that allow for exposure to commodities. So that's where I think things like at one point, at one level, U.S. Steel and Alcoa and Cliff Natural Resources are a function of commodity prices to a certain extent. Devon Energy too, although they have some company risk. But there's a number of multi-leveraged commodity ETFs that I'm going to start doing a separate analysis on and I'll be looking at like weekly charts and trying to find the supported spring crossing in commodities. And there may even be a nice pair trade in there too, if we get any kind of weakness and sell off in equities. So it's just the very extreme nature of the move in commodities suggests a possibility of a reversal. So just this is a strategic view here because we're looking at almost a 50-year time horizon. It's also interesting just to note how it's almost a standard time interval between those peak moments, and you could even look at the early 1980s as another intermediate peak as well. So just food for thought, and that's going to trigger me to start looking for commodity gains. In the meantime, at the simplest level, DBC, the Deutsche Bank blended commodity, gives you a mix of 4 different categories of commodities. You get precious metals, base metals, energy, and agriculture in a blended commodity ETF. There's also DJP and some things like that. I'll do a more formal report, I think, this weekend on what that looks like. So that's on my radar, the trade after next. And then meanwhile, in terms of the precious metals, I just think it's just studying wheat and precious metals is sufficient for to get exposure on that side in a very liquid instrument. Okay, so let's see where we are. What kind of? Let me cover this one before I get any further. Did I cancel? I think I deleted my. Open up my my market. There we go. Okay, so just to take care of some other housekeeping stuff here. This one was a coffee talk Bob Rourke and I were looking at. So this was actually from yesterday. This is one of those that supports that discussion that we've been having this week about using the trailing stop for an entry, that as you start seeing the PSAR descending, and then you start seeing the, oops, let's get that smaller. And then you start seeing the, the turnaround behavior in here. Just notice the, in Bob's markup, he uses a slightly different form of the MACD histogram. I think he's using a 4 and 30, and then a tighter Bollinger Band mean. But he gets a little bit of an earlier front run. So when the winter goes into the spring on the 4,30 MACD, that gives you a couple days earlier entries or alerts, if you will. And then it crosses the baby dragon inside here. And then if we look at that a little more closely, this is the point that I've been making before, and that as you start getting into this early alert stage, and I'm just going to highlight, when on his chart, when the MACD histogram rolled over the and goes into the spring and then crosses his dragon, that's when he wants to start tracking. So this is where the idea of, and now you got winter becomes spring and starts to curl up. That's where my thought is that you could be considering these kinds of stop entries on the previous PSAR. So before the PSAR flips, you have some price level that tells you that, yeah, you want to be in that on the long side, even if the PSAR hasn't completely flipped yet. Because you can see in this, on this day of this great big candle, which is almost an 8% move, well, the RL10 hasn't even crossed the PSAR yet. So that's where the PSAR dot is, and that's where the RL10 is. So when this bar closes, at the close, the next thing will happen at the start of the next bar. When it opens, that PSAR is going to now be down here at approximately about that level right there. And so then you would end up getting, presumably, if this kept going up, you'd get an entry up in here. Well, when you see that kind of a move, that sort of tells you there is some buying interest. And so instead of giving back, potentially that much potential gain, once you see that spring developing and it's starting to cross the RLXD, so you get the RLXD right here. This is where, to me, you could make the argument for lagging the PSAR dot by 1. So I would go, to me, the thing I asked the boys to take a look at there was, so this red dot, I'm going to make that color red, the red arrow. The red arrow is pointing to the live candle and where the PSAR is. So that thing opens up down here, right at the right where the price has now crossed the dragon, the arrow tends cross the dragon, and then the PSAR for that bar is the red dot. So it seems to me that if we just lagged it one day, we could then, oops, sorry, we could have this. This would be the active entry here, and then we could get an entry right there. Then if we do have a runaway move like we just did, you're already surprised into that at a price. It would have to have a significant price improvement because you didn't know that candle was going to do that. All you knew is that thing was starting off really well. Let me draw it with as a black line here. So this thing starts off here. Oops. Size of that blob. So it opens here and then starts creeping up. Now price has hit where today's PSAR is, but if you then take the entry at the second PSAR or the third one, so if you lagged 1 or lagged 2, then you get a really nice entry right there, and that allows you to gain, this. It allows you to gain this green, what I'm going to draw as a blue bar here. You get to capture that blue bar on the day of execution. Then it closes well, and then the PSAR is going to flip, and then you're going to see the PSAR dot down here. Even if you made that half an entry, you'd be really happy with that as well. So I think you could even get in with half at one of those lagging PSARs, and you could frame that the day before, and it would still take quite a move, because the 3 previous days were here, here, and here, and you're not getting an entry until that green. So that would be the entry you get on a 1-day lag on the PSAR. So it would still take a decisive move, and you would feel good about entering there, even though that was the live bar, even though the PSAR flip had not occurred yet. I think you'd be happy with that one. So anyway, that I just wanted to show that's the argument behind front in favor of front running, because otherwise you got to wait for the total close of the day. And now you're gonna look at this and say, oh, I can't even get in until the next day, because now you've seen you have seen a harsh winter. Winter became spring, the RLXD, and at the close is when you would see this PSAR print. So you can't even get in till the next day. That actually could be a nice way to get into a turbo trade. So if you're a day trader, if you're going to be willing to do some intraday stuff, you could actually treat that with half a position as the turbo, and then just get alerted into the position, and then just go manage it. And that way you're surprised into the position. Okay. So that's for Worth and Glenn to continue to work on. Okay. So thanks for the indulgence. I just wanted to clarify that. Just while we're here, this is Catherine, who's done a really nice job. So she just took the hybrid trading workshop, and she took it because I sent some of the files to her husband, who was taking the course at a self-paced, and she just was interested in it and was listening to some of the podcasts. So she just quickly took the flashcards from the supported spring crossing, read the rules for the kata, started trading it, and so this is her results in the first month. So that was pretty amazing. So she's got a nice equity curve looking here. You don't mind that equity curve? Pretty steady. You like this histogram. When I read that histogram, the very first thing that I look at is no losses worse than 1R, correct. I look for in the land between -1 and +2, I'm looking for something like a normal looking curve. So I'm kind of looking for something like this, which is there. Now this is unusual because it doesn't, because it chops it off at -1. What that does is it doesn't allow you to experience a fat left tail at all. So it's not unusual to see this loss between -0.5 and -1 being a little bit larger. But otherwise, you get a really nice orderly flow that's leaning to the right. And then, so that first thing is nothing less than 1. That's correct. Looking for a normal-ish looking histogram between -1 and +2, and I want to see positive expectancy. Oops. I want to see positive expectancy because that's the normal professional space right in there. And then number 3, I'm looking for the possibility of fat right tail, and she's got some of those. So everything looks good. This is her scatter plot, and you notice down here again, nothing here at under -1. So that looks good, and it is kind of normalizing around 0.3 expectancy and starting to get a little better. So that's a pretty stable expectancy. You can make bank on that. Then when we looked at her stats, so she's got let's see, 70, basically 80 trades. So it's going to be a statistically significant number. Her average win to average loss is 5-4, and oh no, I'm sorry. Yeah, the win rate is 54%, loss rate 44%. So the win rate is 5-4, and then the payoff is 8-3. Well, I'm sorry, not 8-3. Basically 9-6, which is 3-2. So you win 10% more than you lose in terms of frequency, 54-44. And then when you win 3, and when you lose 2. How often do you want to play that? So that's like an unfair coin that when you win pays 3, and when you lose you pay 2. How often do you want to play that game? That would be forever. That's how long you want to play that game. As many times as you can, for as long as they'll let you play the game. So I consider that to be pretty interesting data for a young lady who is has just become interested in trading because her husband's interested in trading. I hope she's in here so I can embarrass her. And spent a week learning the rules, and a month perfecting her understanding of it. She's getting it done. I almost want to say I rest my case, but the defense never rests. Okay. So, onward. All right, let's see what happened today. All right, so we liked yesterday's price action because it broke that downward channel, and it gave us, so Monday was a strong finish, but at the top of the channel, and then today, fractional gap down, and then a 1 ATR move through the dragon, pulled back a little bit right in the last 15 minutes, but still closed above the spine of the dragon. That was Friday. And then today, fractional gap up, broke out of the dragon, touched the PSAR, pulled back slightly, and closed north of the skin of the dragon. So that's actually a strong move. The fact that it didn't run away from us tells us that it wasn't panic buying, but it was the bears suffering. It was the bulls winning on a home game there. So that's actually a pretty favorable move today. Now, what complicates this week is going to be the shortened week and the holiday, and so we'll see what tomorrow will bring. Tomorrow looks to me to be pretty interesting. Tomorrow, to be a win, I think has to close north of the dragon. If it dips back down into the dragon, then I still think we're in this sideways choppy crap that we've seen. I mean, the RL10, that slope of the 10-period regression line, is still sloping down. So I've got some concerns here that downward slope is counteracted by these 3 days up. So I get that. But the dragon is still sloping down. The PSAR is still sloping down. The RL30 is still sloping down. So today felt tactically pretty good. And, we still have a way to go. We still probably have 2 more days of gains that are needed before the PSAR flips. So this is still tactically tentative. And like I said yesterday, it really has to get above this 10-day high at about 314, call 315. It's really got to get through the 10-day high to be decisive. Could it do that tomorrow? It certainly can. The good news would be if it can get above that 10-day high, then I think it's pretty clear sailing all the way up to Z2, because you'll notice that there's almost no, there's no resistance over here at all, with the slight exception of the peak of the dragon here. It's got to get, but if it can get through the 10-day high, then I think the peak of the dragon would be instructive. That's really, I would like to put, so I'm going to put a swing buy there and a swing buy here. So if I can get through that, that's where I'm going to try some tactical trading in this space, generally speaking. So I will play intraday only in this, what I'm going to color is blue. Oops, I'll color this as blue. Damn it. Yeah, so tactical trading in that blue space only. But if it gets through that 10-day high on the market basis, then the market's going to support that move up. And then if it can get through um, the, the dragon, the peak of the dragon here, I'm going to treat those two as really crucial events. That's where I'll be adding multiple swing positions, because then I think it's free and clear all the way up to Z2. And then that's where I would add a third position, because you'll notice that that's very close to the peak of the RL10 anyway. So that would be really, really powerful. Now on the downside, where would I look? It would be tactical trading for me in this yellow zone, all the way down, I think, to the Bollinger Band mean. And if it breaks through the spine of the dragon and the Bollinger Band mean, to me it's red all the way down here. Yeah, so that's where I would start picking up a swing on the short side, right here. And I think at the belly of the RL10, I would add one. And then if the RL270 broke, that's where I would be adding. So if we break out of this 10-day range, then basically we will have a strong swing position that's built off of this tactical trading. So this is really, to me, this is really a critical state. The market's just waiting to see people step up and go for it. The real strength that you're seeing now are the can't lose tech giants. I mean, God dang, Amazon today. I finally bit the bullet and started buying it. It's a little off-putting at $2,700 a share. So you got to get over that. That's just like, if you bought 100 shares at 27, that's like buying one share at 2,700. I mean, it's the same thing. I know it feels different, but I had to get over that price level. And so we're going to take a look at Amazon's trade today. And there may be something that's useful about Amazon at $2,700 a share. Like, people are not trivially buying that thing because of the cost of the position. Whereas you might see, like in Twitter, where I've been attracted to Twitter because it's relatively low price share and untech, it feels like it's easier to trade. It really isn't. Whereas Amazon today was really, really easy. I probably missed the boat on that thing months and quarters and years ago. I've been getting my Amazon exposure through the S&P and through the XLK and the Qs, but so there's something to think about there. So that's what the market frame looks like to me. I just think we're right in the middle of this cluster. We're just in the middle of a giant cluster inside here where we have price just cleared the dragon. You got the PSAR and the previous RL30 peak right here acting as resistance. You have the weekly high and the high of the day at 312 with some resistance. Then the 10-day high and Z1 with some resistance. On the downside, you have skin of the dragon, low of the day, spine of the dragon, belly of the dragon, the moving RL10, the bottom. So there's a lot of congestion and noise inside here. This is Crocodile River, by the way. So, but if this were to resolve outward, this is how I'm going to get long on swings, and if it collapses, that's how I'm going to get short on swings. So I'm ready to go in either direction. Meanwhile, I'll be doing 80% of my effort is looking to play very correctly the intraday trades and not holding positions overnight unless this market condition gives me favorable indications. Because even on a symbol that was really strong, that could get undercut by a sharp change in market condition. So you could have something that was moving out well, it was leading the market while the market was going up, and then the market gets undercut, and then that could just cut the legs right out from underneath it. So to me, this is still a market condition trade, and I got to get this one right. That's why I'm spending the time on this. Okay, so that's what I want to say about that. Let's go see what happened today in the sectors. So the S&P had a pretty good day, up 0.7. The Dow was undercut today, minus 0.2. So almost a % difference between the S&P and the diamonds. And then IWM, the Russell, where is he at? And then also bucking the trend of the S&P, the Russell was down 1. So here's an odd one. S&P up 0.7, the diamonds down 0.2, and the Russell down 1. That doesn't bode well for the bull when your mega caps couldn't maintain today, and the speculative traders were tapping the brake pedal. There's got some concerns there. That's a cautionary tale. All right, so let's see what was better than the S&P. Let's take a look at the sectors. So we got healthcare was fractionally better, Mexico discretionary, Simon Property Group and Virgin Galactic up 2% each. Real estate Brazil, Twitter. Triple Qs were really strong today. This TQQQ, that's becoming my new favorite way to play the tech. Tesla, Amazon just smashed it today at 4%. Facebook 4%. Beyond Meat, against my better judgment, 6%. And then that FRTA from the materials, I tried a little bit in the morning, up 6%. So healthcare discretionary, what's missing out of here is energy, finance, materials. And that's part of the reason why I think the Russell and the diamonds did poorly. So here's materials at 0.2, tech at 0.15, energy, let's see, or I should say finance down here at minus 0.8. And where's my energy? And energy down here minus 2.4. So some of the big losers today are some of my trading favorites. Alcoa 2.5%, Cliff 2.7%, XOP 3%, U.S. Steel minus 4.7%. It's now under $7 a share, and so that has become a decisive downward move. So if you remember our discussion when this yellow box was the point of discussion, it's voted down now 2 days in a row in a strong fashion. And to me, it's broken through what was previously the strong support over in here. That whole thing has now voted to the downside. And so look out below in U.S. Steel. The next price level down is going to be down around the PSAR, the original PSAR shift. Which is really down here at Z3. So this thing, $5 is in range. And so that one's going to be a high priority for me on the failure. On the other hand, if this is somehow able, if that was just a washout and ready to hold, the last time it was down in this region, it gave us a strong move up. So we know what that could look like, a strong move up from there. So I'm gonna go back to my original yellow box of death right there and say, if it can get above 750, it should be free and clear. So I'm ready to play the box in either one of these directions. I'm ready to get short at the instant that it takes out that low. And then if it reverses halfway up the stack and takes out yesterday's lows on the way up, I'm ready to get long at that thing at about 705, and I'll play that tactically. So I really like U.S. Steel as a trading vehicle only. One day, not making the swing trade bet on this thing, unless it's to the downside. But on the upside, this is just going to be a chance for a one-day pop, and that thing could move $1 and a half in a single day. So that could be a 10 or a 15R if we get a large directional day tomorrow. So that would be the least surprising move of all tomorrow. Cliff, now since we're down here, let's look at Cliff. Not as bad. That's still ready to break out either direction. Alcoa pulled all the way back into the yellow. So I think on both of those, I want to do this. Yeah, I'm ready to break that in either direction. I like that. Let's see that go in either direction. Devon Energy got smashed today. Devon Energy also weak. And again, if this support level, this complex support level right in here fails, we're ready to go to the downside. Just follow the breakout. Okay. Brazil did. This is Brazil. This did better than the S&P. I really like that one going long tomorrow. It gave some possible trades for you today on the intraday with the kata, but it cleared the top skin of the dragon, and it's ready to go up. So let's go Brazil. Facebook continues its beautiful run. That's 3 days of joy in a row. That's the trade of the week. We like this back here when it broke out. It broke through that previous support. So that's good to go. Twitter made a big move today, so I'm going to go check in on that one. Liking it. We're long Twitter from here. And I like how strongly it closed. So I'm ready to add more positions to that if it breaks above 31. I like that one a lot. Simon Property Group. It's had sold off sharply and is still, I think, is going pretty strong. I like that. That little upward move. It held above the consolidation zone, so let's get back on board that one tomorrow. Mexico was better than the S&P. Cautiously optimistic. Start with a hybrid frog and get ready to go. So I like all of those. Now Win was one that we watched that thing lose 40%. I'm going to find out where he is. Yeah, today's promise never really materialized. It gave an effort to 78 and then sold off $5 from there. So that's one that I think we got to be ready to get short on again. Whichever way it breaks out of that yellow box, I'm ready to go. And really just a hybrid trade. There's no reason to take a swing bet right now. Start it as a hybrid trade and then take it from there. So this was Win today. Had a nice gap up, a quick burst up, and then nothing but suffering, pain and suffering the whole day. Notice how smoothly that trades intraday. That's why it's a frog champion. It's very directional. Notice how useful the Bollinger Band mean is on that one. Once it gets everything out of the river, that thing just kind of persists, and the Bollinger Band is a really nice trailing stop. So there were a couple, probably 3 good moves inside that today. And you're also going to notice that on the front end, there was a really nice hybrid frog on this one. Nice gap up, hybrid frog entry, and then exit in the usual way over here at the Bollinger Band mean. I'll show you that trade when I get into that stuff. So that's that. Let me jump to the daily report. Let's cover some of that. Look for some tactical opportunities for tomorrow. Okay, we've covered the health check. So still bullish normal. We got well today on the 90-day look back. It got into overbought. It's overbought on the 3 and a 90. And the other ones are starting to feel a little recovery. It's failure to fail, I suppose, is what's happening here. ADX is still weak. The risk Z is still showing risk off, although it's continuing to slightly improve. And it's leaning towards, it's trying to lure us into some swing trades. So I'm ready to tentatively take some swing trades. I've already marked out the price conditions that I would need to see in the market to tempt me to be a swing trader. 10-day max pains, I look at American Express, ExxonMobil, Nucor, Boeing, Walgreens, Devon Energy, all opportunities. The min pains are the ones that are just dominating. Microsoft, United Health, Merck, Procter & Gamble, Cisco, no surprises. Dow Tactical, a ton of dojis today. Half the Dow 30 were on dojis. There's only a handful now that test out well on the auto framer. American Express, Coke, Verizon, Johnson & Johnson, McDonald's, Nike. Healthcare was big winners today. Pfizer, Merck, United Health. Pfizer's worth a look. That was a 10-day min pain and has been dominating. Look how good Microsoft and Apple, though, have been compared to their peer group. 10 days, 1 month, 3 months, 6 months. It's just hard to argue with that. Microsoft was pretty good today. Nothing else jumps out at me there. Again, tomorrow I want to get the market right. ETFs, only 3 test out well on the auto framer. That's energy, finance, and consumer staples. No breakouts of the trading ranges and only a couple dojis. But Brazil showed some strength today. Brazil is up over the last 1 day, 10 day, and 1 month and 3 months. Now it's only negative on the 6 months. So Brazil has shown some real healing power here. Maybe the worst is over. No surprises on pinch and stretch. Nothing really to remark on other than Pfizer has that really expanded pinch box. That's the sign of a very wide river and a long-term directional move. So if we go look at Pfizer, got to add Pfizer in here. It keeps coming up on my radar. Boy, was that a vote against optimism? So you've had these two support levels, one here and one down here, and it jumped out of both of those today, and then just sold off harshly. I just think that one's ripe for some more failure tomorrow. I feel dumb for having missed that one. That was a mover that I could not find today. That's going to look like a no-brainer when we get on it. Maybe not. The Z3 pinch breakdown. So I really disliked the way that thing could not hold. On the other hand, I like what that means because then tomorrow there's a real chance for Pfizer to pay off on the downside. Yeah, I think Pfizer could definitely pay off to the downside tomorrow. Auto framer, just a handful above 2 now. So what's looking good in there? Johnson & Johnson, XOP, Walmart Finance. There's some opportunities for you with mechanical trading. Little to no change in the fractals. Microsoft, Apple, Cisco continue to lead the way to the upside. The 1-day pinch, Apple had such a narrow range today that Apple is really pointing the way to upside gains. Well, you got to be ready for Apple tomorrow. And I like that the S&P is in 4th position there at 2.8 to 1. So that was a relatively narrow range day today. And so just a regular breakout could be really powerful. And that reinforces the point of this being a critical state. So on that list, you got Apple, SPY, Diamonds, XLK. That's going to be a nice one to the upside as well, I think. So that would be on my short list of things to hold for a swing trade. Let's look at the daily on XLK. Absolutely. Look at that. Nice. It's already above the previous peak. That's free and clear. It has completely erased the entire sell-off with that. That's about as V bottom as you want to get. That's a great big blue check mark saying "Go boys, go." So to me, the XLQ. Let's compare XLK to QQQ. I said XLQ. I meant QQQ. So I'm going to compare that to TQ, which is the triple Q. That one actually has been lagging the S&P. The S&P's tech. Right? So I think there's some room to the upside. Well, that's going to be fueled by XLK. So this little difference right here, this is the underperformance of the Qs compared to XLK, the sector spider for tech. So that tells me actually that the Qs have more room to go to play catch up. So there's another triple leverage tech sector that's not linked to the Qs, TECL, I think it is. That's pretty liquid and tradable. So I'm going to take my pick between either the triple Qs or that one to see which way I go to start leveraging tech. But I really like XLK being above the previous swing high. That's people voting say, hey, I don't know what the future's going to hold, but I bet you it's tech, and it's the large caps in tech are going to win. And that really just leads me to, I just want to cover, that's as far into the daily report as I want to go, because I think you got to get the sectors and the market right. I want to get into some of the trades from today. This one is, let's see, Facebook? Yeah, Facebook. So this is the third day of that powerful up move in Facebook. And just right by the numbers, this is supported. Let me get the big arrows here. This first trade was just bad form on my part, but I was committed to playing by the rules. I hate when I do that. And you just see how much this gave back. Ugh. Such bad form. I was going to try and hold out for the, for the rules, but the PSAR hadn't even gotten above the entry yet, and I was already back to scratch, so I just said I can't take it. And then that basically bottom ticked me, so then I re-entered. So it's like the first trade. To me, that's like I opened the free envelope and there was nothing in there. Or a paper dollar came out of the envelope, but then the wind blew it out of my hands, so I never really had possession. A fumble. So then I just re-enter, and that makes as if the first trade doesn't even happen. And then let me look at it from the bottom so that arrow doesn't confuse. So I keep that support in until the PSAR gets above my entry. Then I jump it to the PSAR, bring it over to the Bollinger Band mean, and then just exit with the Bollinger Band mean to here. The next one is like a Z3 breakout, and winter goes to spring. So I'm just using the PSAR right here. I just pick up the Bollinger Band mean and take the routine exit. I mean, just like downtown. And the give back on this one was small, and the give back on this one was small. So excuse me, Facebook and Amazon were just both grinding all day today. Here's the next sequence in Facebook. This is like the spring crossing again. This is like, I treated this as summer, fall, a 1 bar winter. So really summer, fall, and it had already crossed the dragon with hardly a pullback at all. So I just bought it here, and very quickly it got to the Bollinger Band mean and just took that one. That sure is easy. And the give back was small. Then it was a high, a lower high. So this felt like they supported winter crossing, typical stop, typical exit, small give back, supported spring, basically a scratch, supported winter, fractional win, routine give back. So that was just by the numbers today, just being a good Army mule and just following, not trying to overthink it. Just wanted to take a lot of trades today. This is the next sequence. This is the afternoon on Facebook, coming out of lunch, and a big give back. I managed to keep a fractional gain this time. Then it immediately, it takes me getting out to really support the next move. So I just get back in. Right here, I pick up the PSAR and hold that till the Bollinger Band mean comes. I gave back a lot. On the next one, on the re-entry, I gave back a lot. On the next one, I gave back some. And so I'm pretty satisfied with that. That's 4 in a row without trying to over-optimize. I felt it was very relaxed. Next one up, this is Brazil. This is from the morning. So this was just it had a strong finish yesterday, gap up, hybrid frog, and Bollinger Band, easy. Later in Brazil, oops. Had a harsh winter. Let me draw that one. So, big harsh winter. Supported spring crossing. Routine stop. I took a sniper exit here on half. Manager's exit in order to set up the re-entry right where the sniper got out. Just re-enter, typical stop. Typical give back sniper, manager, right by the numbers. That took me into lunch. This is finance. So this was the open. This was a great big sideways chop. Collapsing dragon at Z2 and collapse below here. Violated that PSAR. So short one, routine give back. It got me at the Bollinger Band mean just in time to set up the next collapse. Hey, if this does that every time, I hope that does that to me every day. Every day. Sell off, routine give back, stop and reverse, routine give back, gain, and then the exit at the Bollinger Band mean in order to get me back in. If it wants to keep collecting the blue on me to make me feel bad, I'm loving it. And then a routine capture. This is win, full of win. So here was a gap up and or gap up to here, frog box entry or a hybrid frog entry and routine exit at the Bollinger Band mean. Missed it. Supported winter. That's also an owl. Second position, when this collapses, owl. Third position on the collapsing dragon. Small give back. Big win on 3 positions. And small give back. I missed the rebound, but I was oriented to the downside on this one because it felt down. And then the Z3 excursion with the routine stop. This is one where the routine stop actually helped me because I kept it up here at the top of the yellow box until the PSAR gets all the way through the yellow box. Then I pick up the Bollinger Band mean all the way down and a small give back. Here's one that'll just make you cry. Amazon, for crying out loud. The entry down here at 27.70 a share. Sideways quiet channel breakout. Bollinger Band exit. Spring crossing reentry. Bollinger Band exit. Spring crossing reentry. Bollinger Band exit. Spring crossing entry. Bollinger Band exit. Spring crossing entry. Bollinger Band exit. And this is 28.90. So that's, 280, almost 200 a share on a $10 risk. Jeez, Jiminy Crickets. Just something to consider, when we start thinking about the size of the boxes, the give back boxes. If you take that $10 box, that first exit you don't take. Second one you do. And that actually improves the exit. And then as soon as you re-enter. So that Bollinger Band mean exit is a pretty good proxy for the trailing stop. I don't mind that at all. It would protect you against that sell-off. And then it kept you in all the way up in here. So if you use that as the yellow box, that yellow box then convert it to a hanging blue box, that's really going to improve your technique. Somebody asked me to look at the cues. This is probably going to break my heart. I know it is, because I was looking at TQQQ all day today. I just had too many other things going on. It was a span of control. But that really got me interested in, God dang it, come on, Kenneth. It really got me interested in TQs because the Qs themselves were good. So the TQ is going to trade the same way as the Qs. It's just the leverage one. Yeah, I mean, there's your supported spring cross. Not quite as clean as Amazon, but still definitely some gains. I was very tempted in here when I saw that spring crossing, that as this was running up, I was very tempted to just hang on to that as a swing, but I was going to wait another day. I'm glad I did. I did not hold for a swing, but I'll be ready on that one tomorrow. Particularly, again, if it's a little morning hook and go, I'm going to be on that like a fat kid on cake. So those are my trades today. I just want to do some quick looks at the crew. Try to give some quick feedback. John, is John in here tonight? Yeah. So John, you had posted a question about on the like when you get these strong sideways channels, and then you get these breakouts. I kind of like that second one myself. I understand the first one as being the breakdown of that most recent belly of the RL10. But if you don't take that, I mean, I don't mind taking that because the price you pay if you're wrong is very small. So it doesn't cost you anything to just try it. And when it pays off, you're happy. But if it doesn't work, then the amount that you paid is small. But by the second one, I think you have to be in because that was the deepest penetration. In this sideways, you had it's almost like a reverse head and shoulders. I don't know what they would call that, but you had a lower low, then a higher low. But if this breaks between that lowest low of the last three, that's why I like the second one. The third one, it's decisive. You have to be in that one, not later than. So I think I would probably be the second one on that one. That feels correct to me. I would alert on the first one. If I didn't get it, I would certainly be there by the second one. Okay, this series was fractional wins. This is just good kata performance on IWM using both SSC and SFC. Um, the only thing I might say is, on one hand, you say, hey, what if I don't trade at lunch from this, like this 12 to 12:15? The cost of those is relatively small compared to the wins, so I don't mind those. I think it's good discipline, and you never know which is the one that's going to leave the station. But I like the quick reversal. It's almost like a sniper in reversal, and then a quick recovery. So I think you're okay there. That's you're getting muscle memory built in. That's pretty good stuff. This series, this is going to be an argument for why you want. Let's see, this series. Well, I think you want standard trade sizes, so that you can kind of normalize as playing with the same size chip each time. That's going to make the R difference a little bit smoother. It's not going to be as very, so the size of the move is always sort of a standard daily execution risk. So as you start getting proficiency on these symbols, I think that's what you're going to find is a good trade-off for you to kind of smooth that out. That's where I kind of I'm almost at the point where I'm using that minimum manageable risk box over hundreds of trades in DIA and EWZ. We sort of have standardized trade sizes on those, and you're going to quickly, I think, sort that out. Maybe a fraction of the long-term frog box, or go find that minimum, the Z3 minimum from the previous day when it was very quiet. Find that minimum noise channel there, and then start using that as, and just commit to that as the standard execution risk. Then I think you'll be happy. Here's 2.6 in SPY. The sniper might have done a little better on the first one at 2 o'clock. I thought it did pretty good on that second one, and that's late in the day, so that sell off there is for the young guns. Let them have that, but that's pretty good work. Good work on both of these. There just wasn't much in that late morning. Good technique. The sniper's calling wants your attention on EWZ on this one, because in both of those we could have gotten a fraction. I just, especially on this first one here, after a peak and then you have a lower high, and then this one rolls over pretty quick. The dragon's rolling over right where the other one rolled over. Maybe you could keep half of that, and it'd be hard to squeeze much out of that second one. But that's a good exit and a great one on the third trade. Really like that one. Oh, EWC, hybrid frog. That early entry, hybrid frog. Get on him. Hybrid frog. Yeah, John, I think you'll make a decision at some point when you commit to the kata, and then when you want to commit to start developing the sniper. So the way I would do that is I would coach you to do it the same way that Glenn did, and that is be mindful of the kata, but now trade it with a sniper's mentality, and then go backwards at the end of the day and compare the kata rules to your performance against the kata, and then that will start helping you normalize your feelings about the sniper. Because when you're actively engaged as the sniper, there's going to be an emotional charge. So what you really want to do is compare the sniper You know, if you're going to be the sniper the whole day, that kind of stuff. And then go back and do the kata after the day is closed, and then do that side by side comparison. That is going to sharpen your eye so much that that will be, I think, the final piece of the puzzle for you. I think you're really going to like that. Yeah, and that's what I mean by the sniper. If you adopt that sort of half sniper, half manager, that's what I do most of the time. Uh, um, and I'm very satisfied with how relaxed that makes me feel, because then I don't sweat any individual trade that much, and I can take 5 or 6 more trades a day just because I just don't care anymore. Should I be the sniper or just the manager? Just split the difference and watch how much easier your life feels. Look how sloppy it seemed I was today with all those blue box givebacks. But that made it very easy. The cognitive cost was trivial. So I wasn't getting tired or worn out at all. So I strongly suggest adopting that mentality. Give that a try. Antonio, when you listen to this, shrink the size of the MACD, expand the range of the price boxes, turn the candles to black bars so you don't get distracted by the flashing lights, and get rid of one of those PSARs. Put the correct PSAR on, because it's like I got double vision. It's like I need 3D glasses to really get this integrated correctly. And I think you're ready to start with the supported fall crossing as well, because you will get less frustrated once you see the opportunities on both sides of the kata. Good technique here. Although the later morning ones, I think, yeah, if you're just doing the spring crossing, that's fine. Supported fall crossing, and in this, there should be a re-entry in here after 10:30. Start adding that to your kata. Yeah, and is this? I'm not sure I recognize whose chart this is, but yeah, if you're already seeing the difference between the kata and the sniper, finish up the kata, be technical with. Oh, that's Griff. You'll be good to go, and then you'll notice. Yeah, I think this is. Yeah. You're starting to notice these other opportunities once more. You're in good shape, Griff. Stay with the program, complete the discipline, and you're going to be in good shape. Not bad. A 1.41 position sizing R for the week with a non-optimized rule set. Just chew on that for a while. The accumulation of these little pieces as you go, it just adds up. It really does. So nice work, Griff. And on the last one, Antonio, same comments as before. So good shape, guys. Keep up the fire. That Amazon, Amazon. If you haven't taken the options course with Danny, you might consider taking that options course, because he's showing ways to manage risk on that and being very efficient on capital. There's a reason why he's been in the money management business for 20 years as a hedge fund manager. He is really doing some amazing work. You ought to go look at his case studies on klbundle.com. Man, kl-bundle.com. He's doing some amazing work. I just I can't say enough about him. I just so much respect for what he's doing. All right, guys, that's everything I got.